This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome to the Luxembourg Fundcast.
Welcome, everyone. Today, we're taking a deep dive into something pretty interesting, debt portfolio acquisitions. Specifically, we're looking at the whole legal and structural side of things right here in Luxembourg.
It's definitely a hot topic.
It really is. It's, a dynamic field. Luxembourg's always been flexible, structure-wise, but now there's this big boost from a new, harmonized European regulatory framework.
That's right, a big change. So our mission today is simple. Give you a clear, practical handle on why Luxembourg is becoming such a key European hub for these deals, both performing and, importantly, non-performing debt. And for you, if you're working in financial services, the big question is probably, well, why Luxembourg? Why is it gaining ground in this complex area? And what does that actually mean for your day-to-day, for your strategies?
That's a great way to frame it. And to really get it, we need to sort of zoom out a bit first. This whole focus on buying up debt portfolios, especially these non-performing loans or NPLs,
right.
It didn't just appear out of nowhere. It really comes from, over a decade of effort across Europe to shore up the banking sector after the 2008 global financial crisis.
The long shadow of 2008.
Exactly. You had banks bogged down with high levels of these NPLs. It was a real drag on their profits, tied up capital they could have been lending out, and ultimately it slowed down economic growth across the EU. It's not just finance. It's about the bigger economic picture.
Makes sense. A systemic problem needing a systemic response. So to help everyone follow along today, we've kind of boiled it down to two key takeaways. Think of these as your main signposts for our chat. First, there's a brand new law, the law of July 15th, 2024. This has fundamentally changed the game for non-performing loans, specifically those originally issued by EU banks. It sets up a whole new mandatory regulated system for what they call credit servicers and credit purchasers. This means new ways of operating, new compliance hoops, new strategic thinking needed. Second, Luxembourg's own securitization law, that's the law of March 22nd, 2004, especially after some big updates in 2022, works hand in glove with its really strong financial collateral law from August 5th, 2005. Together, they offer, frankly, unparalleled flexibility and security for structuring all kinds of debt deals.
That includes explicitly allowing active management of portfolios now and different ways to fund things, like direct loans.
Exactly. Which makes Luxembourg a real go-to place for complex stuff like collateralized loan obligations or CLOs. We'll circle back to these points at the end. Okay, let's unpack that first takeaway. This huge new legal framework for non-performing loans, NPLs. What's the story there?
Right. So the why behind it, as I mentioned, is those high NPL levels post-crisis. Banks couldn't lend effectively. So back in 2017, the Council of the European Union launched this action plan to tackle non-performing loans. A key part of that was trying to build up secondary markets for these distressed assets.
Selling them off the bank's books.
Precisely. But the big problem was fragmentation. Every country had slightly different rules, different ways of regulating the servicing of these loans across borders. It just created confusion, high compliance costs, legal uncertainty. Not ideal for a pan-European market.
A real headache.
Definitely. So the EU's answer was harmonization, create a common framework through a new directive. The idea was to smooth out these bumps in the road, make cross-border deals easier, while still making sure borrowers' rights were protected.
Okay, so that European directive then landed here in Luxembourg. Tell us about what this law of July 15th, 2024.
That's it. The directive got translated into Luxembourg law, the one we now just call the NPL law. If you check Legilux, the official source, it was published July 18th, 2024, and kicked in just 4 days later, July 22nd. It directly implements that EU directive, that's the Directive EU 2021/2167 on credit servicers and credit purchasers. And what it does is create a whole new specific legal regime for this market, which before was really just governed by general contract law, much more specific now.
Right, so who and what does it actually cover? Getting the scope right seems crucial.
Absolutely paramount. It applies specifically to the transfer and the servicing of non-performing credit agreements that were initially issued by a credit institution based within the European Union.
Okay, EU-originated NPLs. And how is an NPL defined under this law?
It basically aligns with the definitions used by the European Banking Authority, the EBA, and also the Capital Requirements Regulation, or CRR. Generally speaking, a loan is non-performing if payments are more than 90 days overdue, or if it looks unlikely the borrower can repay without the lender having to realize the collateral. And the law creates two new types of regulated players. First, the credit purchaser, that's acheteur de crédit in French. This is basically the investor, any person or company except a credit institution who buys the rights to these NPLs as part of their business.
The buyer.
The buyer. And second, the credit servicer, gestionnaire de crédit. This has to be a legal person, a company, and they manage and enforce the NPLs on behalf of the purchaser. This is the really big change. Credit servicers are now officially a new category of professional of the financial sector, or PFS, here in Luxembourg.
Ah, so regulated entities now.
Exactly, fully regulated and supervised. Their job includes things like collecting payments, maybe renegotiating terms with borrowers, handling complaints, keeping borrowers informed.
Are there any exceptions?
Yes, important ones. It generally doesn't apply if the servicing is done by the credit institution itself or by an authorized alternative investment fund manager, an AIFM, or a UCI TUPS management company that's undertakings for collective investment in transferable securities. Also, NPL transfers that happen before December 30th, 2023 are grandfathered out.
Okay, so this new PFS status for credit servicers, that brings in the CSSF, right? Luxembourg's financial regulator, the Commission de Surveillance du Secteur Financier. What's their role now?
A central one. As a PFS, credit servicers need authorization from the CSSF, and they are under its ongoing supervision.
What does it take to get authorized?
Well, you need to be a proper legal entity, first off. You need minimum subscribed and fully paid up share capital that's at least 75,000 euros, but it jumps to 150,000 euros if you plan on holding borrower funds directly. Then there's governance and substance. You need at least two people running the show, the management body, with good reputations and enough professional experience. Plus, robust internal controls, risk management, proper accounting, and crucially, strong AML-CFT policies that's anti-money laundering and counter-terrorist financing.
And the timeline for approval?
The CSSF aims for efficiency. They have 45 days to check if your application is complete and then another 90 days to make their decision.
You mentioned a European passport. That sounds significant.
It really is a huge advantage. Once a credit servicer gets its license from the CSSF here in Luxembourg, it can provide its services across the entire European Union, either by setting up a branch or just offering services cross-border. No need for separate licenses in every single country. The CSSF just notifies the authorities in the host country. It's a real game changer. This move from a basically unregulated secondary market to this structured, supervised one, it effectively puts a quality seal on Luxembourg-based credit servicers.
Enhances credibility.
Massively. Boosts investor confidence, lowers counterparty risk. It makes Luxembourg a much more logical hub for anyone running pan-European NPL strategies. So yeah, regulation acting as a catalyst for growth, that's the idea.
Regulation as catalyst.
Yeah.
I like that. Okay, let's dig into the practical side now. What does this NPL law actually mean day to day for the different players? It seems to formalize things quite a bit.
It really does. Take the banks selling the NPLs. They now have a legal obligation to give potential buyers all the necessary information before the transfer happens so buyers can do proper due diligence. They also have to report on their NPL sales twice a year to their own regulators.
More transparency there. And for the buyers, the credit purchasers.
They benefit from those information rights, obviously. Makes due diligence more robust. But the key thing is, if the purchaser isn't already a regulated entity itself, like a bank or an AIFM, they must appoint one of these newly authorized credit servicers to handle the loans.
Mandatory appointment.
Mandatory. And if the purchaser is from outside the EU, they also need to appoint a legal representative within the EU. Critically, though, the borrower's rights don't just disappear when the loan is sold. The purchaser is still bound by all the original consumer protection rules and loan terms.
That's important for borrowers. And the credit servicers themselves. The new PFS.
They face a whole raft of new operational duties, very strict conduct of business rules. They have to act in good faith, be fair, professional, provide clear information, respect privacy, avoid harassment, the basics of good conduct, but now legally enshrined. They also need to set up clear, free procedures for handling borrower complaints and maintain detailed records correspondence, instructions, the servicing agreement itself for 5 to 10 years.
Okay, that covers the servicing aspect under the NPL law. But how are these deals typically structured? Where do people actually hold these acquired debt portfolios in Luxembourg?
Good question. While the NPL law handles the servicing, the go-to vehicle for actually acquiring and holding the debt portfolios here is almost always a securitization vehicle, or SV. That falls under Luxembourg's securitization law, the law of March 22nd, 2004.
The SV, we hear that a lot.
You do, for good reason. It's incredibly flexible, especially after the big overhaul it got in 2022. You can set up an SV as a standard company, like a public limited company, an SA Société Anonyme, or a private limited liability company, an SARL, Société à Responsabilité Limitée. But since 2022, you can also use partnership forms. Things like a common limited partnership, an SES, Société en commandite simple, or even a special limited partnership, the SCSP, Société en commandite spéciale. These partnerships can be tax transparent, which adds another layer of structuring options.
And the compartmentalization feature, that always comes up.
It's the standout feature, really. Think of it like statutory ring fencing. A single SV entity can create multiple compartments, almost like subfunds. The assets and liabilities of each compartment are legally segregated from all the others.
So trouble in one compartment doesn't spread.
Exactly. Even if the whole SV were to go insolvent, the creditors or investors of compartment A only have recourse to the assets in compartment A, not B or C. This makes it super efficient operationally and cost-wise if you plan on doing multiple distinct deals under one roof.
And those 2022 amendments you mentioned, they did more than just add partnerships.
Oh, yes. Two crucial things. First, funding. SVs used to be pretty much limited to funding themselves by issuing securities. Now they can be funded by any type of loan or financial instrument. This opened the door much wider for institutional investors who might prefer loan agreements over notes.
More flexibility on the funding side.
Huge flexibility. And second, the really transformative change. The law now explicitly permits the active management of debt portfolios within an SV. There's a condition the financing instruments used can't be offered to the public, but for institutional deals, it was a watershed moment.
Active management. That put Luxembourg on the map for CLOs, right? Collateralized loan obligations.
Absolutely. And CDOs, collateralized debt obligations. It made Luxembourg a premier jurisdiction for structures where the manager is actively buying and selling underlying loans. And here's where it gets really interesting. You see how the NPL law and those 2022 securitization law changes fit together.
The synergy.
Exactly. The 2022 changes gave you the technical tool, the flexible, tax-efficient SV structure capable of active management. Then, the 2024 NPL law provides the specific regulatory guardrails for managing the riskier stuff like NPLs within that structure. It defines who does the managing a CSSF authorized credit servicer and the rules they have to follow.
So you can combine them.
Perfectly. Imagine you're a fund manager setting up an actively managed NPL fund. You could use a Luxembourg multi-compartment SV, maybe an SCSP, for tax reasons for efficiency. Then you either get your management company authorized as a credit servicer by the CSSF, or you appoint an external one. That servicer can then use its European passport to manage the NPLs you buy across different EU countries.
A true one-stop shop.
That's the goal. Combining Luxembourg's flexible structures, tax efficiency, strong creditor protection laws, and now a robust passportable NPL management regime.
That makes a lot of sense. Okay, we've got the structure and the regulation. Let's get into the nuts and bolts of the deal itself, the key legal agreements. That's we're talking the sale and purchase agreement, the SPA, and now this revamped credit servicing agreement, the CSA.
Absolutely, core documents. The SPA is where the ownership of the debt portfolio actually changes hands.
What law typically governs these SPAs?
Often, especially for cross-border deals, you'll see English law or maybe New York law chosen by the parties. Luxembourg courts generally respect that choice unless it clashes strongly with local public policy. Inside the SPA, you've got key clauses. Obviously, who the seller and buyer are. Maybe the buyer is a specific compartment of a Lux SV. A very precise description of the assets being sold, often using eligibility criteria and exclusion criteria, especially for NPLs.
Defining exactly what's in the box.
Exactly. Then the purchase price for NPLs, almost always a deep discount to face value, how it's calculated, any adjustments, how payment works. Then you get into the really heavily negotiated stuff. Representations and warranties, or R&Ws. These are statements of fact the seller makes about the loans, things like having good title, the loan data being accurate, compliance with lending laws, no hidden lawsuits. Buyers rely heavily on these.
And the buyer makes R&Ws too.
Usually less extensive, confirming they're legally able to buy, have the authority, have the funds, that kind of thing. You also have covenant promises about behavior between signing the deal and closing it, like the seller promising not to change loan terms without the buyer's okay, and conditions precedent or CPs, things that must happen before the deal can close. Successful due diligence, R&W is still being true, no major disasters happening. And finally, indemnification. This is the remedy if an R&W turns out to be false. This is where you negotiate things like how long the seller is on the hook for claims, the survival period, the maximum payout cap, and whether there's a minimum claim threshold, basket or deductible.
A lot of negotiation points there, clearly driven by the due diligence findings.
Directly linked. Good diligence gives you leverage on these risk allocation points.
And you mentioned the NPL law has really changed the other key document, the credit servicing agreement, the CSA.
Totally transformed it. Before the NPL law, the CSA was just a commercial contract between the portfolio owner and the servicer. Now, under this new regime, it's a mandatory regulated agreement with specific content requirements dictated by law.
So what has to be in it now?
It needs a detailed description of the servicing activities, collecting payments, renegotiation, complaints handling. The servicer's pay structure must be clear. Crucially, it must include undertakings, promises that the servicer will follow all the strict conduct rules from the NPL law, fairness, data protection, clear communication, no harassment.
What about handling money?
If the servicer is authorized to actually receive borrower payments, the CSA has to spell out the procedures very clearly, including the use of segregated client accounts at a proper bank. And outsourcing, if the servicer wants to delegate some tasks to a third-party credit service provider, the CSA needs to specify the conditions for doing that. It must be clear the main servicer is still fully responsible, and the credit purchaser has to be informed.
So the CSA is now partly a regulatory compliance document, not just a business agreement.
Precisely. It's subject to CSSF scrutiny. Negotiating one now involves ticking regulatory boxes as well as agreeing commercial terms. It forces more robust, legally sound agreements around things like borrower protection and fund handling.
Makes sense. So understanding the law and the documents is crucial, but actually doing a deal requires more, right?
Right.
Negotiation skills, getting the price right, managing the process.
Absolutely. The art of the deal aspect is vital. Negotiation, especially in law, is often about information asymmetry. Leverage comes from due diligence.
What kind of diligence are we talking?
Usually 3 types. Legal diligence, checking the loan agreements, any security, searching for litigation, basically ensuring the loans are valid and enforceable.
Right.
Financial diligence, looking at borrower payment history, creditworthiness, likelihood of future payments, and collateral diligence, getting appraisals, checking legal status of any underlying assets, assessing if and how you could enforce against them.
And how do those findings feed into negotiation?
Directly. If diligence uncovers issues, the buyer will push for stronger R&Ws from the seller, longer survival periods for claims, lower or zero baskets. The seller naturally wants the opposite, limit their liability, maybe qualify R&Ws to the seller's knowledge, push for shorter survival periods, higher caps, bigger basket.
A real tug-of-war.
Often, yes. And for NPL specifically, a lot of negotiation centers on the quality and completeness of the loan data provided by the seller, the documented collection history, and the practical legal hurdles of actually enforcing that debt in whatever country the borrower is in.
Okay, diligence drives negotiation. What about pricing these things, especially NPLs? Must be tricky.
It's definitely part art, part science. For NPLs, the main tool is discounted cash flow analysis, or DCF. You try to project the likely future cash flows you'll recover from the portfolio, factoring in the probability of recovery, the timing, the cost of collection, and then you discount those future flows back to today's value using a pretty high discount rate to reflect the risk.
High risk, high discount rate.
Exactly. You'd usually cross-check that DCF value against what similar NPL portfolios have recently sold for in the market, if that data is available. And speaking of data, a really important development here are the EBA NPL data templates. Historically, one of the biggest challenges in the NPL market was poor, non-standardized data coming from the selling banks. Made due diligence a nightmare, drove up costs, created big gaps between what buyers would bid and sellers would ask.
Inconsistent information.
Very inconsistent. The NPL directive actually empowered the European Banking Authority, the EBA, to create standardized templates implementing technical standards or ITS for the data sellers need to provide on each loan. This is huge for market efficiency.
How so?
Well, with standardized data, buyers can analyze portfolios much faster, price them more accurately. It should lead to narrower bid-ask spreads, quicker deals, lower transaction costs, a more transparent and efficient market overall.
That sounds like a definite improvement. What about other transaction costs beyond the purchase price itself?
They can add up. If you are issuing securities and listing them, say on the Luxembourg Stock Exchange, there are regulatory fees like a prospectus approval fee is currently 5,720 euros for debt and annual maintenance fees. Then you have significant advisory fees, legal, tax, financial modeling, valuation experts, plus the ongoing fees you'll pay to your appointed credit servicer.
In taxes, how does that work with Luxembourg SVs?
This is a key part of the Luxembourg advantage. While an SV is technically a taxable entity in Luxembourg, it can usually achieve effective tax neutrality. It does this by deducting all the commitments it owes to its investors, things like interest payments, profit shares, even dividends from its taxable base. The result is typically minimal or even zero corporate income tax payable by the SV itself.
So the tax burden passes through to the investors, largely.
Generally, yes, depending on the investor's own situations. Plus, because the SV is a fully taxable Luxembourg resident company, it can usually access Luxembourg's very large network of double taxation treaties, over 80 of them, and benefit from EU directives like the Parent Subsidiary Directive. This helps eliminate or reduce withholding taxes on payments flowing into or out of the SV, which is a big advantage compared to using, say, offshore centers.
Worth noting the standard corporate tax rate, though.
Yes. The standard combined rate is currently 24.94%, and there's a net wealth tax of 0.5%. But as I said, proper structuring of the SV typically mitigates these significantly at the vehicle level.
Okay, complex but efficient if structured right. How long do these deals typically take from start to finish?
It varies, of course, but you can think of it in phases. Phase 1, preparation and marketing may be 4 to 6 weeks. The seller gets their data together, prepares an info memo, starts sounding out potential buyers. Phase 2, initial bids and diligence, maybe 6 to 8 weeks. Buyers sign non-disclosure agreements, get access to a virtual data room, do preliminary checks, and submit non-binding offers. Phase 3, binding offers and final negotiation, another 4 to 6 weeks. The seller picks a shortlist, buyers do deep dive diligence, submit final binding offers, and then usually one party gets exclusivity to hammer out the final SPA. Phase 4, signing to closing can be quick, maybe 2 to 4 weeks, or longer if there are complex conditions precedent to satisfy. Then you close, money changes hands, title transfers.
And that CSSF authorization for the servicer needs to fit in there somewhere.
Absolutely. That 90-day CSSF decision window, starting from when the application is complete, often runs in parallel with the deal timeline. You need to factor it in carefully to avoid holding up the closing.
Right, a lot of moving parts. So we've covered the new rules, the structures, the deal process. Let's pull back again. Why Luxembourg? What makes it stand out so much in this space? It sounds like more than just one thing.
It really is a combination, a synergy. The foundation is Luxembourg's incredibly robust yet flexible legal framework. 2 laws are absolute cornerstones here. First, the financial collateral law, that's the law of August 5th, 2005. It provides a remarkably simple, effective, and crucially bankruptcy remote way to create and enforce security interest pledges, basically over financial assets like loan portfolios. Enforcement is designed to be fast and outside of normal, lengthy insolvency procedures. That gives lenders huge legal certainty.
Surety you can rely on.
Exactly. Second is the securitization law we discussed March 22nd, 2004, as amended. Its flexibility is the massive draw. It can handle almost any type of asset you want to securitize, allows diverse funding methods, including direct loans, offers different legal forms like those tax-transparent partnerships, SCS-CCSP, and now explicitly allows active management. It also legally recognizes concepts like limited recourse and non-petition clauses, which reinforce that bankruptcy remoteness.
So a strong legal toolkit. And the tax side we touched on.
That's pillar number 2, tax neutrality and efficiency. As we said, SVs can deduct commitments to investors, usually bringing their own corporate tax bill down to near zero, and being onshore, fully taxable entities allows them to tap into that huge treaty network and EU directives to minimize withholding taxes globally. That's a major competitive advantage.
Makes sense. Beyond law and tax, what else contributes?
It's the whole ecosystem. Luxembourg has this deep pool of highly experienced professionals, lawyers, tax advisors, auditors, corporate service providers who specialize in exactly these kinds of complex cross-border financial deals. Plus, market access. The Luxembourg Stock Exchange is one of the world's leading venues for listing international debt. You can choose the EU-regulated market or the slightly more flexible Euro MTF market. Either way, it gives issuers access to a wide range of institutional investors.
And the fund industry connection.
That's key too. Being the biggest investment fund center in Europe, second largest globally, means there's just a massive concentration of financial expertise, service providers, and pools of capital already here. It creates a very dynamic environment. And underpinning all of this is stability and reputation. Luxembourg is politically stable, economically strong, a founding EU member, consistent AAA credit rating. It offers a secure, reliable, highly reputable onshore jurisdiction. Investors value that.
So it really is the combination.
It's the synergy, absolutely. That's the unique selling point. Think about how you can layer these tools. An investor uses a tax-transparent SCSP, allowed under the securitization law, to buy NPLs. They fund it with a mix of senior loans and junior notes, that's the funding flexibility. They grant a secure bankruptcy remote pledge over the NPLs using the financial collateral law. Maybe they list the notes on the Lux SE for market access. And now they appoint a CSSF-regulated credit servicer operating under the NPL law with a European passport.
You can build a very tailored solution.
Exactly. Highly customized, efficient, secure structures. That integrated toolbox is Luxembourg's ultimate edge.
Okay, looking forward then. What's on the horizon for this market? More deals, new regulations.
Market trend-wise, I think we can expect continued, probably increasing, volumes of NPL sales across Europe. You've got ongoing economic pressures, higher interest rates putting stress on borrowers, plus banks still looking to optimize their balance sheets under regulatory pressure. And demand seems strong too, especially from specialized private debt funds. Many of those funds choose Luxembourg for their domicile, often using the RAIF structure that's the Reserved Alternative Investment Fund.
Why the RAIF particularly?
Speed to market, mainly. RIFs are managed by an authorized AIFM, but the fund product itself doesn't need direct CSSF approval, which can speed things up compared to other regulated fund types. Very popular for strategies like debt funds.
And regulatory changes coming down the pike.
Always. A few big ones to watch. First, DRA, the Digital Operational Resilience Act, that applies from January 2025. It puts tough new requirements on financial entities, including these new credit servicers for managing their IT risks, reporting cyber incidents, and managing risks from third-party tech providers. Then there's the upcoming CRD VI Capital Requirements Directive 6. It has provisions that could impact how non-EU firms provide banking services into the EU, potentially encouraging more activity to be booked through EU hubs like Luxembourg. And AML-CFT, anti-money laundering, and counter-terrorist financing remains a massive focus for supervisors. The establishment of the new EU Anti-Money Laundering Authority, AMLA, is only going to intensify scrutiny. Regulated firms, including credit servicers, will need to continuously strengthen their controls.
Definitely a dynamic regulatory landscape, too. Okay, let's bring it home. To wrap up, let's quickly revisit those two key takeaways for everyone listening. First, that law of July 15th, 2024, has genuinely created a new era for the NPL secondary market here. It's now a properly regulated, supervised environment with clear rules for credit purchasers and credit servicers. This means more transparency, better investor protection, and ultimately a more efficient market. Second, it's that powerful blend of Luxembourg's updated securitization law and its top-tier financial collateral law. This combination provides an incredibly flexible yet secure toolbox for structuring almost any kind of debt portfolio deal. Add in the tax efficiency and the deep local expertise, and you see why Luxembourg is such a leader for sophisticated debt transactions in Europe. This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.